revenue at $108 billion. This even as vaccine rollouts raised the prospect of a return to normal shopping habits. Earnings also scored a beat of $15.79 per share, while the company gave a bullish second quarter sales forecast of $110 to $116 billion. Shares jumped in extended trade. Twitter plunged 10% in extended trade after releasing first quarter earnings. Revenue for the first 3 months was in line with Wall Street estimates of just over $1 billion, translating into a 28% jump year on year. But the social media platform added only 7 million new daily active users for the period and delivered a weak forecast for the second quarter that missed analyst estimates. Chinese property developer Sichuan Langguang bonds have hit record lows on concerns about liquidity. Earlier this week, a Chengdu-based builder rattled investors when it repaid a dollar bond with proceeds from a stake sale in a former unit. It still has about $3 billion in outstanding onshore and offshore bonds, some of it due next month. Langguang says it may consider selling a portion of itself to investors as it works to raise money and avoid becoming China's latest property developer to default.
Take a look at trading across Asia right now. We are seeing Kiwi stocks gaining ground for a third consecutive session. We are at a 2-week high. We did get New Zealand's annual trade surplus narrowing further in March, though, although the activity outlook remains very strong. Sydney futures at the moment under pressure, but remember, the ASX 200 has done really well. We're headed for the best month since November. They've outperformed other developed Asian markets. Nikkei futures under pressure right now, despite the fact that the Japanese yen is holding steady at that 2-week low against the US dollar. We do have tons of data out of Japan. Do watch out for the jobless rate, industrial production, also manufacturing PMI. When it comes to South Korea, we do get industrial production at the top of the hour as well. Coming up, the market outlook with Cardigan Management senior analyst Julia Herman joins shortly, plus the financial imperative for addressing diversity in Hollywood we discuss with McKinsey. That's it for Daybreak Australia. Daybreak Asia is next. This is Bloomberg. Welcome to Daybreak Asia. I'm Chevryan in New York.
And I'm Heidi Stroud-Watts in Sydney. We are counting down to Asia's major market opens. Our top stories this hour: Asian stocks poised for a lower start this Friday as investors digest mixed big tech results from the US, Amazon sailing past estimates while Twitter tumbling on lackluster revenue guidance. China's clampdown on tech escalates. Regulators impose sweeping curbs on the financial arms of 13 companies, including ByteDance and Meituan. And China's big banks see profit margins squeezed as policymakers lean to lenders to contain debt.
We have breaking news out of South Korea. We are getting the industrial production numbers for the month of March. When it comes to those month-on-month numbers, we're seeing now a contraction of 0.8%. This is a bigger contraction than was expected. It's also a contraction from a revised upwards number in the previous month of 4.4% growth in the industrial production numbers. Remember, we did see another wave of infections affecting South Korea in March. So we had a recovery and then we had a slump in the month of March. This, of course, coming at a time when we're seeing a little bit of volatility in these numbers. Switch to the year-on-year numbers, and we're seeing growth of 4.7%, which is higher than estimates, and is also a significant growth from the previous month of February. Remember, though, we do have base effects to account for in South Korea. All in all, though, we are seeing pretty strong external demand for South Korean goods. We have seen manufacturers' confidence rising in May already. This week, we saw Samsung beating expectations. First quarter growth numbers also turning positive year on year. So we'll be watching those very closely, Heidi.
All right, let's take a look at how we're setting up for the market open this Friday. So, what are you watching?
Well, this Friday, U.S. futures are just nudging slightly lower this after the S&P index hit a fresh high in the wake of that solid GDP report from the U.S. and earnings very much in focus as well. And here in Asia, stocks are set for the best month since December. Australian shares are the outperformer in the DM Asia space in April, but it is Taiwan that takes the crown as the best performer in Asia, with the TAIEX adding nearly 7% in April. And today's GDP report likely to show the economy growing at the fastest pace in a decade. We also have plenty of earnings on tap across the region, including from Komatsu, Tokyo Electron, Hotel Shilla, and more. And with that, pulling up the terminal, we're just about at that halfway mark when it comes to the Asian reporting season. And so far, when you take a look at companies that have reported on the MSCI APEC index, taking a look at how we're faring with performance when it comes to results so far in the region, about 60% of companies on the index have beat on revenue, while less than half have topped profit estimates, with the biggest upside seen in the mining space for materials, as you can see right here using the EA function on the terminal. Now, we've seen this amid the commodities rally, of course, Sherry, which PIMCO says reveals the very real shortage of raw materials, given that backwardation has cropped up across different markets. Sherry.
Right, so let's turn to that big Amazon beat. The tech giant blew through estimates across the board, encouraging investors that the company's pandemic momentum isn't waning. Share surge in after hours trading. Let's bring in Bloomberg TV West Coast reporter Ed Ludlow. Ed, so really a beat on all fronts. Give us some of the highlights.
Yeah, a beat across the board, but the market really paying attention to that forecast for the second quarter, or the current quarter, where Amazon says sales will be between $110 and $116 billion, significantly higher than anticipations, and then on top of that, operating income of $4.5 to $8 billion. As you said, the pandemic boost to the e-commerce business and the cloud business is not waning. If you look at the top line growth drivers, though, it isn't so much e-commerce, it is AWS, the cloud platform. Yes, AWS is a much smaller proportion of overall revenue, but it makes up a bulk of net income. So, when you see 20% growth in that unit or above, that's a pretty good sign for the top and bottom line. A little muted reaction in after hours. This was a significant beat, a significant upgrade to the forecast. Shares up pretty modestly in the scheme of things.